What if I told you that the law that quietly saved the American financial system wasn't the Federal Reserve, wasn't some master plan from Washington, and wasn't even meant to last but a temporary, deeply unpopular, almost forgotten statute written by a senator most people hated, a law that sat unused for 6 years, gathered dust in Treasury vaults, then suddenly roared to life in the summer of 1914 and for a few terrifying months, became the only thing standing between the United States and total collapse. To see how that happened, you have to go back to a cold day in October 1907. The air in New York is brisk, but the men in line on Wall Street are sweating. The queue snakes around Broadway, pushes past the corner, and keeps going. Clerks, shopkeepers, small investors, all clutching passbooks and envelopes. They are not waiting for theater tickets. They are trying to get their life savings out of the Knickerbocker Trust company before it fails. Inside the marble lobby, tellers are shoveling notes and coins across the counter as fast as they can. In the back, managers stare into open vaults that are visibly thinning out. By 12:30 p.m., the math is undeniable. A man steps out onto the front steps and makes the announcement everyone dreads. Knickerbocker is closed. The doors slam, the crowd surges, the panic metastasizes. By afternoon, depositors are hammering on the doors of the Trust Company of America and Lincoln Trust. Other banks stop lending. Call money rates spike toward 100%. The stock market implodes. There is no Federal Reserve, no deposit insurance, no emergency playbook. Washington's Treasury Department is slow, conservative, and sitting on gold that refuses to move while the financial system has a heart attack. In this vacuum, the fate of the American economy lands on the shoulders of one private citizen, J. P. Morgan. 70 years old, sick with a bad cold, he is playing solitaire in his library at 219 Madison Avenue when a crisis lands in his lap. For 2 weeks, he becomes a one-man central bank. He summons bankers to his home, threatens them, cajoles them, locks them in his library, and refuses to let them leave until they agree to pool reserves and rescue key institutions. He bullies Wall Street into collective action, and remarkably, it works. The panic is contained, but when the dust settles, people in Washington confront a chilling thought. The United States has effectively entrusted its survival to one aging financier. Morgan will not live forever. Next time he might be dead, or he might simply refuse to help. Luck is not a policy. The response to that realization is a law that almost no one today can name. The Aldrich Vreeland Act of 1908. History books usually treat it as a minor prologue to the Federal Reserve Act of 1913. A clumsy stepping stone. That is a mistake. Aldrich Vreeland was a radical emergency measure that fundamentally altered the definition of money in the United States and created a bridge between a rigid 19th century currency regime and the elastic central banking world of the 20th century. And when war breaks out in 1914, that bridge is the only thing preventing the American financial system from shattering. If you enjoy unearthing these lost pieces of financial history, the obscure laws, the forgotten panics, the quiet decisions that shaped the system we still use today, support the channel, subscribe, hit like, and tell me in the comments where in the world you're watching from and what time it is. It's always fascinating to see how global this community has become. To understand why Aldrich Vreeland had to exist, you first need to see what was broken in 1907. The United States was operating under the National Banking Acts passed during the Civil War. The currency of the era, the national bank note, was technically very safe. Every note issued by a national bank was backed 100% by U.S. government bonds deposited in the Treasury. If the First National Bank of Peoria issued a $5 note, it had to own $5 worth of government debt on file in Washington. That design made counterfeiting and default difficult. The dollar was hard in the sense that every note had a bond behind it, but it was also, in economic terms, stupid. The supply of money was tied to the supply of federal debt. If business boomed, if factories needed working capital and farmers needed cash to pay harvest wages, banks could not simply respond by issuing more notes. They first had to buy more government bonds. If Washington wasn't selling new bonds, or worse, if it was paying down its debt, the pool of eligible collateral shrank. At the exact moment the private economy needed more money, the currency system refused to expand. This inelasticity was deadly in 1907. As fear spread, ordinary people hoarded cash. They yanked deposits out of banks and trusts and literally put money under mattresses. The banks, drained of reserves, desperately needed to issue more notes to meet withdrawals and keep commerce going. But they lacked the necessary bonds and could not acquire them quickly enough. The money supply plunged just as demand for liquidity exploded. A financial fire broke out in the middle of a monetary drought. Everyone could see the flaw. Inelastic currency became the buzzword of the day. Into this crisis stepped Senator Nelson W. Aldrich of Rhode Island. Aldrich was not a populist hero. He was, in many ways, the face of the Eastern establishment, the most powerful Republican in the Senate, father-in-law to John D. Rockefeller Jr., and a reliable friend of what critics called the money trust. Yet Aldrich was also pragmatic. He had watched the 1907 panic up close and understood that the old system could not handle modern finance. J.P. Morgan was right. The country needed some mechanism to create money quickly in a crisis. There was a problem. The political climate was hostile to anything resembling a central bank. Democrats and agrarian populists, led by figures like William Jennings Bryan, saw central banking as an instrument of Wall Street domination. They liked the idea of easier credit, but hated the idea of New York bankers administering it. Aldrich knew that a full-blown central bank bill would die in 1908. The country needed emergency plumbing long before it agreed on a permanent blueprint. So Aldrich partnered with Representative Edward Vreeland of New York and crafted a strange, hybrid solution. The Aldrich-Vreeland Act did not abolish the national banking system and did not create a central bank. Instead, it created a stopgap device, emergency currency. The core idea was bold. In times of crisis, selected banks would be allowed to issue temporary banknotes that were not backed by U.S. government bonds but by other high-quality assets, municipal bonds, railroad securities, and commercial paper short-term loans to real businesses, to conservative sound money advocates. This sounded like legalized counterfeiting. Money backed by a railroad loan? Money backed by trade receivables? It seemed dangerously loose. Aldrich countered that in a panic the issue is not solvency but liquidity. Railroads and factories do not become worthless overnight. The problem is that their assets are not cash. If good loans can temporarily serve as backing for currency, the panic can be short-circuited. The act allowed national banks to form voluntary national currency associations at the local and regional level. A group of banks in Chicago, for instance, could pool eligible assets, have them examined by the association, and then apply to the Treasury for emergency notes backed by that collateral. It was a decentralized workaround. Local bankers judged the quality of assets, while Washington simply turned those assets into cash when needed. The bill immediately ran into a political firestorm. Democrats filibustered. Senator Robert La Follette of Wisconsin spoke nearly 19 hours in a marathon speech, denouncing Aldrich-Vreeland as a gift to the money trust. Critics argued that these currency associations would become private cartels, giving big banks even more power. Supporters insisted that the alternative was another 1907 or worse. With the memory of breadlines and bank runs still fresh, Republicans forced the measure through. President Theodore Roosevelt signed it on May 30, 1908. It was explicitly temporary, scheduled to expire June 30, 1914. Most observers assumed it would be an unused bridge to a more permanent reform. But the act had a second, quieter component. It created and funded the National Monetary Commission, chaired by Aldrich, to study banking systems abroad and recommend long-term reforms. For the next 2 years, Aldrich traveled to London, Paris, and Berlin, meeting governors of the Bank of England, the Bank of France, and the Reichsbank. What he saw stunned him. European central banks could adjust interest rates to manage gold flows, issue elastic currencies that expanded and contracted with trade and agriculture, and use bankers' acceptances as liquid instruments to feed commerce. Compared to that, the American system looked antique, rigid, fragmented, and dangerously fragile. Aldrich returned to the United States, converted to central banking, but the phrase central bank remained politically toxic. He needed something that functioned like a central bank without bearing the name. That need resulted in one of the most famous episodes in American financial lore, The Secret, meeting on Jekyll Island. In November 1910, a private rail car left Hoboken, New Jersey under cover of darkness. Its passengers were a small group of senators, Treasury officials, and top Wall Street bankers: Aldrich, Assistant Treasury Secretary A.P. Andrew, Frank Vanderlip of National City Bank, the forerunner of Citibank, Henry Davison of J.P. Morgan & Co., and Paul Warburg, a German-born partner at Kuhn, Loeb & Co., two outsiders. They were merely wealthy men headed south for a duck hunt. They used first names only to avoid detection. Their destination was the Jekyll Island Club off the coast of Georgia, an exclusive retreat for the ultra-rich. For about a week, cut off from the outside world, they drafted a comprehensive plan for an American central banking system. They sketched out regional divisions, reserve mechanisms, and the design of a new elastic currency. Their product, known as the Aldrich Plan, envisioned a National Reserve Association that would hold member banks' reserves and issue a flexible currency against short-term commercial paper. They avoided the phrase central bank carefully, but in substance that is exactly what it was. Politically, it was radioactive. When Aldrich unveiled the plan in 1911, opponents branded it a Wall Street creation, written by bankers for bankers. Rumors about the secret Jekyll Island meeting only heightened suspicion. Then the 1912 election transformed the landscape. Republicans split. Woodrow Wilson won the presidency, and Democrats, having campaigned against the Aldrich plan and the money trust, seemed in no mood to adopt anything associated with Aldrich. Yet the need for reform remained. Wilson, along with Congressman Carter Glass, quietly took the Aldrich blueprint, preserved its key mechanics, regional reserve banks, an elastic currency based on commercial paper, and altered the governance structure. Instead of bankers directly controlling the system, a Federal Reserve Board appointed by the president would sit at the top. The bankers would operate the machinery. The government would officially steer it. The result was the Federal Reserve Act. After a bruising legislative fight, Wilson signed it into law on December 23, 1913. History often treats that date as the clean turning point. Problem identified, Fed created, issue solved. But passing a law is not the same thing as building an institution. In early 1914, the Federal Reserve existed mostly on paper. 12 regional reserve banks had yet to open. They had no vaults, staff, gold, or operating rules. District lines had to be drawn, stock sold to member banks, directors appointed. The Fed was, in practical terms, still under construction. Meanwhile, the clock was ticking on Aldrich Vreeland. Its authority expired on June 30, 1914. If a panic erupted that summer, the old emergency mechanism would be gone and the new central bank not yet functional. The system would stand naked. Only a few officials recognized how dangerous that gap could be. Among them Treasury Secretary William G. McAdoo, who was also Wilson's son-in-law, watching Europe slide toward war, assassinations, mobilizations, crumbling alliances. McAdoo saw the financial risk. A European conflict would almost certainly detonate across Wall Street. McAdoo went to Congress and quietly pushed for an extension and expansion of Aldrich Vreeland. He wanted to keep the emergency currency mechanism alive and make it easier to trigger. Legislators, distracted and skeptical, grudgingly agreed. They extended the act for one more year until June 30, 1915. It was treated as minor housekeeping, barely noted in the press. No one realized it was one of the most consequential decisions of the century. 2 days before June ended, on June 28, 1914, Archduke Franz Ferdinand was assassinated in Sarajevo. Within weeks, Europe was sliding into what would become World War I as Austria-Hungary, Russia, Germany, and France mobilized. Financial markets convulsed. European investors began liquidating American securities, railroad stocks, industrial bonds, municipal debt, and demanding payment in gold. Gold, the sacred anchor of the global system, began pouring out of New York on ships bound for London. On July 31, 1914, the New York Stock Exchange closed its doors, shuttered for months in the longest shutdown in its history. The panic facing New York that summer was, in raw numbers, more severe than 1907. This time, the threat was not just domestic trust companies, but the entire world attempting to break open the American piggy bank to get at its gold reserves. The Federal Reserve was in no condition to respond. The Federal Reserve Board was sworn in only on August 10, 1914, in the middle of the crisis. The regional banks did not yet fully exist as functioning institutions. The Fed had no experience, no established tools, and almost no operational capacity. It stood on the sidelines. McAdoo did not. He reached for the only real weapon he had, the Aldrich Vreeland Act, Treasury. Officials sent urgent telegrams across the country. The emergency currency provisions were now active. National currency associations should form immediately and bring in eligible assets. The machinery that had sat in legal limbo for 6 years finally whirred to life. Bankers in New York, Chicago, St. Louis, Boston, and other centers hurried into meetings. They assembled portfolios of commercial paper, municipal securities, and railroad bonds, assets that, under pre-1908 rules, could not have backed currency. Under Aldrich Vreeland, they were suddenly the raw material of money. Associations vetted these assets and forwarded applications to the Treasury. The Treasury, in turn, began shipping physical emergency notes. The logistics had been quietly prepared years earlier. The Bureau of Engraving and Printing had already produced millions of dollars in special Aldrich Vreeland notes, nearly identical to regular national bank notes but bearing a small inscription, citing the 1908 Act. Those notes had waited in Treasury vaults like coiled fire hoses. Now they were loaded onto trains under guard and rushed to banks across the country. When banks opened on those critical August mornings, depositors were lined up, ready to pull funds as they had in 1907. This time, the tellers did not ration withdrawals. They did not close early. They calmly handed out stacks of fresh bills. The psychological effect was profound. A bank run is powered by the fear that the last person in line loses everything. When people see what appears to be an inexhaustible supply of cash, that fear dissolves. Many depositors, reassured by the sight, simply redeposit funds or walk away with confidence restored. By October 1914, the Treasury had issued roughly $380 million in emergency Aldrich Vreeland currency, tens of billions in today's dollars. The massive liquidity injection worked. The banking system did not suspend payments. Few banks failed. Interest rates, which had spiked, began to normalize. Gold outflows slowed, not because the United States slammed the door, but because the world believed its banks would meet obligations. The irony was stark. A temporary law authored by a conservative Republican senator to protect the existing banking system was now being used by a progressive Democratic administration as a quasi-central banking tool. The operation proved that an elastic currency money that can temporarily expand in crisis was the antidote to panic, and that in the last resort, it had to be the government, not a private financier, that provided that elasticity. The existence of Aldrich Vreeland also gave the embryonic Federal Reserve something priceless: time. Because the emergency currency had staunched the immediate bleeding, the Fed did not have to launch prematurely. Its organizers could spend the fall of 1914 setting rules, staffing offices, and opening vaults. Only on November 16, 1914 did the 12 Federal Reserve banks officially open their doors. As Federal Reserve notes gradually entered circulation, the emergency Aldrich Vreeland notes were retired. The act built its own exit ramp. The emergency notes carried a tax that rose the longer they remained outstanding. In normal times, when market interest rates dropped, that tax became too expensive. Banks had a strong incentive to redeem the notes and return them for destruction. By the summer of 1915, nearly all of the $380 million in Aldrich Vreeland currency had been withdrawn and incinerated. The act expired on June 30, 1915. 6 quiet years on the books, 6 explosive months of action, and then oblivion. Its legacy, however, runs far deeper than its lifespan. Aldrich Vreeland fundamentally changed how the U.S. government thought about money in crisis. Before 1908, American panics almost always meant waves of bank failures, suspended payments, and deep depressions. After 1914, the conceptual response shifted. A panic was something to be met with liquidity. The act taught the United States what it meant to be a lender of last resort, and broke the psychological tie between money and either gold or government debt alone. It proved that currency could be backed by the real, short-term commercial assets of the economy: loans to railroads, manufacturers, and municipalities. That mechanism directly informed the Federal Reserve's discount window. When a modern bank goes to the Fed and pledges assets in exchange for reserves, it is following a procedure pioneered by Aldrich Vreeland and battle-tested in 1914. The geographic shape of the Fed, with its 12 regional districts, also owes much to the earlier network of currency associations. Structurally, the skeleton of the Federal Reserve is the skeleton of Aldrich Vreeland, ray-fleshed in marble. And bureaucracy. The act also forces an uncomfortable comparison. In 1914, facing a global war and a seized-up gold market, the United States suffered few bank failures and avoided a deep recession. The fake, temporary system worked. By 1929, the U.S. possessed a full-fledged central bank with permanent authority, professional economists, and a grand building in Washington. Yet in the early 1930s, that institution presided over the collapse of roughly one-third of American banks and a decade-long depression. How could a patchwork emergency law outperform the actual central bank? One answer lies in the difference between automatic and discretionary systems. Aldrich Vreeland embedded rules. When panic pressure rose, when local banks felt the strain, they could activate currency associations and request emergency notes. They did not need a committee in Washington to decide whether they deserved help. The tax on the notes discouraged abuse by making emergency currency expensive once calm returned. It was a kind of mechanical safety valve, open under pressure, closed when normality resumed. The Federal Reserve of the 1930s, by contrast, was a human institution plagued by internal disagreement and flawed economic theories. Fed governors worried about future inflation at a time when prices and wages were collapsing. They fretted over moral hazard if they rescued weak banks. They delayed. The window did not open wide enough or fast enough. The lesson of 1914, that speed matters more than perfection in a panic, had been forgotten. Aldrich Vreeland also represented the high watermark of a particular monetary philosophy, the real bills doctrine, the idea that money should be backed by short-term commercial claims on real goods. Under this view, a loan to a shoe factory buying leather could back the issuance of currency. And when the shoes were produced and sold and the loan repaid, the money would naturally contract. The supply of money would ebb and flow with the real production of the economy. Over the 20th century, that idea lost out to a different model in which central banks create money primarily by purchasing government debt. The modern dollar is not people as money anchored in commerce, but state money anchored in the fiscal capacity of the government. The act also shifted the political Overton window. Before 1908, any idea of the federal government intervening to support banks was denounced as un-American interference in private business. Banking, like grocery selling or blacksmithing, was supposed to be subject to the discipline of failure. Aldrich Vreeland blew a hole in that wall. Once the public saw that government action could prevent panic and protect deposits, inaction became politically dangerous. From that point forward, financial crises were no longer just market events. They became tests of Washington's willingness to use its tools, the path open toward deposit, insurance, New Deal reforms, and the large-scale interventions of the 21st century. A small technical feature of the law also deserves attention: the rising tax on emergency notes. In a crisis, interest rates can spike to extreme levels because cash is scarce. By offering currency at a penalty rate high, but far below panic market rates, the act effectively capped the cost of emergency liquidity, penalized banks for getting into trouble, but ensured that funding was available. Some modern economists have suggested that a similar penalty rate mechanism, tied to collateral quality, might be a healthier alternative to today's ad hoc bailouts. In another sense, Aldrich Vreeland marked the beginning of the financialization of the American state. When the Treasury accepted railroad bonds and commercial paper as backing for currency, it implicitly endorsed their quality. It put a public floor under private asset prices. That precedent, that government will step in to support markets in extremis, remains with us. It stabilizes crises, but it also encourages risk-taking and booms. The counterfactual is sobering. In 1914, the United States was not yet the world's financial hegemon. It owed substantial sums to European creditors and was vulnerable to gold drains. If McAdoo had not quietly pushed to extend Aldrich Vreeland, if those emergency notes had not been printed in advance and shipped on time, the panic triggered by World War I could have pushed the United States off the gold standard and into deep recession, rather than emerging as the arsenal of democracy and global creditor by war's end. America might have stumbled into the conflict as a financial cripple. The later dominance of the dollar was not inevitable. It rested, in part, on the existence of a temporary law drafted by a vilified senator and extended in what looked like a minor technical vote. Finally, the story of Aldrich Vreeland reminds us how fragile and contingent our own institutions are. In 1908, the national banking system seemed permanent. Within a decade, it had been patched, bypassed, and functionally replaced. Today, we take the Federal Reserve, deposit insurance, global dollar liquidity, and digital banking as fixed features of the landscape. They are not. They are the current iteration of a long experiment in managing money in crisis. Like the systems before them, they will one day be tested and found wanting. New stopgaps will be invented, new temporary measures deployed, and future historians may look back at our present arrangements, as we now look back on Aldrich Vreeland, as crude but, in a moment of danger, just good enough to keep the illusion of stability from shattering. When you swipe a card, tap a phone, or hold a Federal Reserve note, you are using instruments that grew out of this forgotten episode. The crowds outside Knickerbocker Trust, the secret rail car to Jekyll Island, the dusty bundles of emergency cash rushed out of Washington in 1914. Our financial system is not a perfectly engineered machine. It is an improvised dam of laws, habits, and confidence, built by anxious officials under pressure. For one terrifying summer, the Aldrich Vreeland Act was the sandbag that held the flood at bay. Its text is gone. Its notes have been burned, but its core lesson lingers in the world of money. The rules are never truly permanent, only whatever works long enough to survive the next panic.